Alright, welcome back to another video. In this video, I'm going to talk about how I go about looking for cheap lottos to put on. Cheap lottos are something that I'll be incorporating more of into my trades because of how much convexity they add, while being so cheap that they fit within my risk tolerance. Now, my definition of lottos might be a bit different from the traditional Wall Street bets version of lottos, in that my lottos are not limited to naked long calls or put YOLOs. Oftentimes, these lottos are in the form of complex spreads like verticals or butterflies. And the main reason in doing so is simply cost reduction. I'm very cognizant of how much debit outlay I throw into these trades. I don't put a lot of money into these trades. See, with spreads, when you're selling another option or multiple options against the core long option, not only do you make the play cheaper, but also you allow yourself to put on even more of these and still fit these gambles well within your risk tolerance. And a higher quantity of lottos means you can comfortably scale out of them if these lottos hit. Let's take an example of a trade that we put on in TSM on Wednesday, January 13th before the market closed. TSM was set to report earnings Wednesday night during Asia trading, so before the close, someone in our chat room alerted that the 130, 140, 150 weekly butterflies were trading for 21 cents. Now that caught my attention, so I put some on and shared out the trade. The next day, these butterflies traded as high as $3.20. We were able to flip them out for a whopping $3.26, so right there, you're looking at roughly a 1,500% gain. Now, what made TSM a good candidate for this type of lotto was the fact that I noticed TSM had been moving very wildly recently, like it would rip really hard to the upside on some days. So knowing that it had the potential to do that, and knowing that earnings was that night, it definitely piqued my interest. Before the close, TSM was trading around $120. So when I saw that the weekly expiry 130, 140, 150 call butterfly, which was $10 higher from where TSM was trading for only 20 cents, the risk reward made sense, right? Let's think about this. If news were to drive TSM higher the next day to around 130, this butterfly, I estimated, would be worth well around like $2 or so, right? The 130 call would be at the money, and at the money calls at the time were trading around $2. Factor in the rise in implied volatility from a large surge to the upside and add another 50 cents or so. Meanwhile, we know that the 140s would stay pretty low because of how much further out of the money they were with so little time left. So in my estimation, this trade had the potential to generate 10x returns. Now, let's say I was more conservative with this estimate, and $125 was the best target that I had in mind for TSM. Would the risk reward still be worth it? Well, if TSM drove higher up to only 125, I felt like the butterfly would expand to at least about 80 cents or so about 4x, which would still be great. And that's what happened the next day. Is this luck? Yes, it always is, but that's not the point. The main takeaway here that I want us to grasp is identifying trades that offer good risk reward and then sizing these trades to fit our risk tolerance. I was playing with money that I was willing to lose, but had the potential to achieve huge returns. And this is money that I'm willing to lose because of how small I kept this trade. The debit was only 20 cents, which is like 1/10 R. In fact, the next day when TSM dipped right at the open, I actually had a working order to fill some more butterflies at 10 cents, and miraculously they filled. So whenever you find these cheap spreads that may seem far and cheap but could potentially end up within range, use your judgment, whether it be, technical analysis, pending news, or just recent behavior and price action. Find a cheap spread, then estimate how much the spread would be worth if the underlying moved to where it could potentially go, and if the return is worth the risk. Consider playing the lotto, of course, sizing to your own risk tolerance. This is the same approach we took with Mac, which I talked about in the previous video, that generated 1000% returns the next day. So to summarize, here's how I play lottos. 1. I look for underlyings with the potential for huge moves. Drivers include technical analysis, such as the TTM squeeze indicator that I mentioned in the past video, breakouts, etc. Short interest data. This is for playing outlier moves to the upside. As we know, highly shorted stocks tend to have huge rips to the upside that the options market does not price in. Or any pending news, earnings, announcements, whatever you could think of. The second step is I find ways to play outlier moves in as cheap of a way as I can possibly make them. If singles are not cheap enough, then I look to do so with verticals, butterflies, condors, etc. The third step is I estimate the potential returns if the underlying moves to X to see if the trade is worth the risk reward. I'll use spread approximation techniques that I talked about in previous videos. You can use risk graphs, or if you want eyeball approximations, I have a video which I made before that shows you how you can approximate values of spreads, links in the description below. And the last step is I size the trade according to my own risk tolerance. I don't throw down more than half R for these types of plays. All right, so that's all I wanted to show you guys today. Hope you enjoyed this one and hope it helps you guys with lottos you might put on. Of course, always making sure they're within risk tolerance. Feel free to join us in our Discord if you want to chat with us anytime or see more trades that we put on, or follow me on Twitter. I post all these things for free. Links to everything I discussed in the description below. Until next time, stay safe and I will see you in the next video. Peace.